All right. Hey, trust you are having an amazing day today. We're recapping this week. I was there in Atlanta at the IMN conference. So busy, so many meetings, speaking there on the economy and the, rebound or recession. I really, quite frankly, didn't even get a chance. I wanted to shoot a video kind of doing an update from the conference, but just had so much going on that we really didn't get a chance to. So I'm here Saturday, I don't really usually shoot videos from here. This is my home office, kind of looking out over the water. I really should work more from here, but quite honestly, I enjoy being in the office. I know most of the time you see me, these videos are coming from my office there at our corporate headquarters. Our team is there. It's just a focused execution. There's no distractions. I've got my own private office here at home, but it's being in the office, it's about creating an energy and a focus. And so I really enjoy that. But anyway, what we spoke about, and I want to kind of update you from some of the items there at the conference. But again, one of the things I talked about is what is the real neutral rate? And what that is the interest rate with which it is neither positive nor negative for the economy. Now, again, that's not really seen or known until kind of after the fact. But if you look back several years ago, the neutral rate was about 0.5%. And, it's thought to be, as economists look at things right now, probably somewhere around 2.5%. What that means is when interest rates begin to come down, and that's part of the economic theory right now, is that you haven't seen as much drag on the economy as interest rates have been raised to 5.25 on the overnight rate with the Fed, is because the real neutral rate, meaning it's neither positive nor negative in terms of adding to the economy or dragging down on the economy, is about 2.5%. So that being the case, it's reasonable to expect that even as the Fed would begin to cut interest rates, that you would expect that it's probably not going to go below 3% in the near term. So again, you could hope to expect maybe there's one cut at the end of this year. And then if you look ahead to next year, 2025, could be 4 cuts that brings it down to about 4%, depending if they're doing 25 basis points or maybe 150 basis points, depending on if there's economic slowdown. Now, the caveat to that is exactly that. Is there and will there be some type of economic slowdown? Will there be more of a reckoning coming together on some of the bank balance sheets? Because again, there's a lot of the regional banks that their balance sheets are weaker, no doubt, from the real estate, the commercial real estate, office buildings, things of that nature that they're carrying on their balance sheet that are not reflected at the values with which they have reflected there. So that is yet to be seen. The other thing that I would say, that definitely when you look at other people, leaders in the Southeast coming together, again, slow transaction volume. There is definitely still what would be some difficulties in some of the managerial executions. Some of the areas like we've shared around Atlanta with the evictions, definitely have affected other significant operators in that area that are in those particular counties as well. And then also just a slowdown of deals, as we've shared as well, that, the numbers just really haven't made solid sense in terms of the acquisition price. But then also the thesis is that, there is definitely an opportunity now, and I would agree with that where we can buy properties that are maybe 30% off of the high from 2021, that really is a good basis. And if we're able to look at that, take advantage of that, and then be able to move forward into the next 3 years where you'd have a lower interest rate environment, there's no doubt you have a winning combination on your hands. So a couple of points just to summarize again. We're entering into a great opportunity, no doubt. Again, it's based on fundamentals. We've always been very conservative in our focus, basing everything on the fundamentals in our underwriting, and that's served us well, even in some of these difficult or more challenging things that we've had to deal with. That's served us well. But with the opportunities that are coming into the marketplace at the end of 24 and into 25, it's going to be a great buying opportunity. And again, if the numbers work there at this current pricing, how much better do things get as interest rates go down in terms of the impact on value? So that is going to be significant. And then also, as I shared before, kind of the higher for longer reality, and that goes back to the neutral rate. And again, a lot of times people were not familiar with, well, what is the neutral rate? And that's really what it is. It's the rate with which the overnight funds rate is neither positive nor negative. And I do believe it's probably going to be higher, and that means interest rates will stay higher for longer. And so we need to be able to adapt to that in our thinking, our underwriting, in the reality of how we structure our investments in capital stack. So I just wanted to share this with you as kind of a wrap up. And again, always enjoy speaking at industry conferences, attending NMHC in January or the IMN conferences that are hosted in the various strategic areas, Southeast, Midwest, Southwest, here in the U.S. Those are great opportunities. So, hey, thank you so much. Have a blessed and victorious week, for this is the week God has ordained for you.